Have you ever wondered how Warren Buffett really became, well, Warren Buffett? I mean, before he was the Oracle of Omaha, before the Berkshire Hathaway empire, he was just a 31-year-old guy running a small investment partnership out of his house. So today, we're going to jump in the time machine. We're going right back to the beginning, using his 1962 letters to his partners to really see the raw, unfiltered principles he used to build everything. Let's open up the playbook.
And right off the bat, the results were, they're just staggering. In his first 5 years, Buffett's partnerships compounded at a whopping 251%. Now compare that to the Dow Jones, the benchmark for the entire market, which only managed about 74% in that same time. That's not just winning, that's playing a completely different sport. So the big question is, how on earth did he pull that off?
All right, so here's how we're going to break it all down in this little masterclass. First, we'll see exactly how big his lead was. Then we're going to dig into the unique way he even defined success in the first place. After that, we get into the real engine room, his three-pronged strategy. We'll even see it in action with a brilliant case study, and then we'll wrap up with his radical, and I mean radical, redefinition of investment risk. Okay, so to really set the stage, let's just zoom in on 1961. The market had a fantastic year, right? The Dow was up over 22%. And in a market like that, it's pretty easy for most managers to look smart. You just ride the wave. But Buffett, he wasn't just riding the wave, he was lapping it. His partnerships were up almost 46%, more than double the market. This wasn't just luck, it was a system, and it was working beautifully. But before we get into the how he did it, we've got to understand what he was even trying to do. What did good performance actually mean to a young Warren Buffett? It turns out he was absolutely obsessed with setting the rules of the game before the first dollar was even invested.
And here it is, straight from the man himself. I believe in establishing yardsticks prior to the act. He knew that in investing, hindsight is a trap. Without a clear goal that you set beforehand, you can always find some other benchmark later on that makes you look like a genius. That commitment to an objective standard, that is such a crucial mental model for any of us investing today.
And his chosen competitor? The Dow Jones Industrial Average. Basically, the 30 biggest, most established companies in America. He picked it because everyone knew it was consistent, and as he was about to prove, it was a surprisingly tough opponent for most of the so-called professionals. He was not grading himself on an easy curve here. Now check this out. This is what's so telling. Look at the biggest, most respected investment funds at the time. Massachusetts Investors Trust, Lehman, Tricontinental. They were barely keeping up with the Dow. Some were even falling behind. And Buffett, he was more than doubling them all. This wasn't just about beating an index. This was about absolutely demolishing the giants of Wall Street. So that's the what. Now for the how. What was the actual engine driving these incredible returns? Well, it all came down to this simple but totally brilliant three-pronged strategy. He broke his investments down into 3 different buckets. He called them generals, workouts, and control situations. Each one had a very different purpose, a different risk profile, and the way he blended them together, well, that was the secret sauce. First up, you have the generals. Now, this is your classic deep value investing. He was just looking for decent companies that were out of favor and just plain cheap on paper. His whole belief was, if you can buy $1's worth of a business for 50 cents, sooner or later that's going to pay off, even if you have no idea when. This patience was all built on having what he called a comfortable margin of safety. Second, the workouts. These were totally different. They were special situations where a company was doing something predictable, like a merger or a liquidation. And the beauty of these investments was that their success had almost nothing to do with whether the stock market was going up or down. It just depended on that specific corporate action happening. They were his source of steady, reliable returns, totally insulated from market craziness. And finally, the most hands-on category, control. In these situations, Buffett wasn't just buying a small piece of a company. He was buying enough to get a seat at the table, to influence management, and to directly force the changes needed to unlock the value he saw hidden inside. This right here was the seed of the strategy that would eventually lead to Berkshire Hathaway. He wasn't waiting for a catalyst, he was becoming the catalyst. Okay, so to really see the power of that last category, we have to look at a control situation that was an absolute cornerstone of his performance in 1962. A company called the Dempster Mill Manufacturing Company. And listen, this was no quick flip. He actually started buying shares in Dempster Mill 5 years earlier, just as a cheap general. But the business was just stuck. It wasn't going anywhere. So he kept buying. A year later, he gets himself on the board of directors, and then finally, by August 1961, he had majority control. This was a long, patient, strategic game. So once he was in charge, he went to work, and the transformation is just jaw-dropping. He took a company with a ton of unproductive assets, basically cash tied up in useless stuff, and turned it into a money-making machine. Before he took over, Dempster had a measly $166,000 in cash and was buried under $2.3 million in debt. Within a single year, he sold off extra inventory, paid down almost all the debt, and built up a $1 million war chest of cash and investments. And the result for his partners? Well, their stake in the company, which they'd been valuing at $35 a share, was now estimated to be worth $50 a share. That huge gain didn't come because the stock market was hot. It came because Warren Buffett himself rolled up his sleeves and fixed the business. He wasn't just waiting for value to appear, he was creating it. And all of this whole approach, it brings us to the final and, I think, the most profound lesson from his 1962 playbook. It's his complete redefinition of what it actually means to be a conservative investor. Seriously, think about that word for a second. What does conservative really mean when it comes to investing? Does it just mean buying boring government bonds? Or maybe loading up on those popular blue chip stocks that everybody owns and talks about? For Buffett, the answer to that was a hard no. For him, being a true conservative had nothing to do with following the crowd. It was an intellectual act. As he put it, true conservatism is only possible through knowledge and reason. It means you know exactly what you own, and you know exactly why you own it, down to the bone. So what he's really saying is that conservatism isn't a product you buy off the shelf. It's a shield that you have to build yourself out of knowledge. It's not about what's popular or what the experts are saying. It's about being right because your facts are right and your logic is sound. And the ultimate test of that shield, it's how well it protects you when the market eventually falls apart. And this was his actual goal, the yardstick he laid out for everyone to see. In a brutal bear market, where the Dow gets hammered down 35 or 40%, his goal was, for his partnerships, to only be down 15 or 20%. His entire philosophy was built on protecting capital first. That was his real definition of safety.
So there you have it, the 1962 playbook. First, set your yardstick before you start playing. Second, mix your strategies, undervalued generals, predictable workouts, and those value-creating control situations. And third, anchor everything in a philosophy of true conservatism, one that's based on reason, not on popularity. He built an entire empire on these ideas. So the only real question left is, which one of these principles do you think is the most overlooked by investors today?